Welcome back to International Finance. I am Andy Kim, your Dr. Finance. Today we're going to cover Chapter 12 of International Bond Market. Now, let me draw your attention to this recent event happened in Suez Canal last month. A huge cargo ship blocked Suez Canal. You remember that? Evergreen, the company name was that, right? And then the Ever Given was the name of the cargo ship. At first time looking at the news, I had a hard time digesting it because what I see on the screen was Evergreen, and the news article was they kept on saying Ever Given. So I was like, that can't be it. But this is what happened, right? The name of the ship was Ever Given, belonging to the company Evergreen, right? And then the Suez Canal has been there for like 200 years, but blocking it like this by natural disaster or kind of strong wind was first time ever to happen, right? And then the other ships, right? If you remember that, right? Many of the ships were blocked together, right? Couldn't go from here to or there. So very interesting things were happening there, okay? And over 2 weeks, the global trade has been, hit hard by this, and then the shipbuilding industries, and then these insurance companies, and they are having a hard time, right? And then now the question becomes, who constructed Suez Canal? And then I want to draw attention to the financing part of this Suez Canal because there was a bond issuance related to it 200 years ago, right? It was of ex-French diplomat named Lesseps, this guy that you see on the picture. And then he devised this idea about constructing a canal. Of course, in the Suez, around that area, for thousands of years, there has been a lot of attempts to build some canals in their own way, depending on the dynasties, right? But this was the most biggest scale one, and then turned out to be the idea was great, so much so that he was able to make a company, right? Form a company called Suez Canal Company. The ownership 44% belonged to the Egyptian government, Ismail Pasha. Largely, this part of the world belonged to Ottoman, Turkish, right? Ottoman Empire. And then the rest of the ownership belonged to French investors, largely. And then for that part, Rothschild Paris department, or their branches, were deeply involved in it. But the thing is, it took a long time, more than expected, and then they could not finance it enough, and then eventually they almost went bankrupt. Essentially, they were in deep distress. Part of the reason was because British government was, British investors and British government's part, they were like very skeptical and then dismarket all these kind of things because their purpose was to compete against French. And then, British Empire's purpose was to go through from the north to the south, right, of the African continent, right? And then the Suez Canal is the starting point of that important post. And they never wanted to make it belong to French investors' hands, right? So they delayed it and then just, dismarket all those things. And then, so they eventually got, this trouble. Then what? They are in need of, this company was in need of money. And then British government came in over there. Okay, Disraeli, the prime minister, was, actively reaching out to Ismail Pasha and said, we're going to, we want to buy your ownership, right? Just hand it over to me. Yeah. For how much? 4 million British pound. Okay. Deal done. And then the British government got in there, they input their money. But the question becomes, how did they finance this money, right? To take over this ownership. That was done by Rothschild, right? They lent this money to British government because of the government guarantee, right? Rothschild issued bonds, not just one bond, but they issued a series of bonds associated with this. The Nathan Meyer Rothschilds, right? London Rothschild family, right? They issued a series of bonds as underwriter, and then this is one specimen or example bond that I bought from the bond book of Rothschild family, called The Necessary Security. I'm going to make one video specifically for this one. It's a lot more fun to understand the bond market. Now, this is the bond. You see the one piece of bond, which is worth as much as £100, which tells us that at the end of maturity, if you bring this piece of paper, this huge piece of paper, the Rothschild family will give you, okay, £100, right, as bond underwriters, issuers, right? Of course, that is on behalf of the borrower, right? On behalf of the borrower. Essentially, the borrower, Egyptian government, will give you £100 for each piece of paper that you bring, this big piece of paper. That's a bond. It's a bondage that the issuer is obliged to pay this much amount of money. Bondage means like obligation, right? So that's the part of it. And then if you come back to the first piece of slide, what you see is that on the right hand side of this big piece of paper, typically they used to have this coupons, right? So before maturity, this is the amount, right? This amount is the face value of the bond, right? Face value. These are the coupons. This is what you get at the end of maturity. These are the money that you get periodically, every 3 months or 6 months or every year, depending on the contract written on the bond over here. Very fine print, you see it, right? Now, that's that. Then, here, the chapter outline is like this. The world's bond market. We're going to talk about this, and foreign bonds and Eurobonds. I mean, given that we discussed a lot about the birth of Eurobond market before, not much time is going to be spent on this chapter 12 anyway. A lot of institutional details, we're going to talk about it, but those kind of things are something you can read depending on your job specification in the future. But anyway, so foreign bonds and Eurobonds, types of instruments, we're going to talk about those things briefly, and then currency distribution, and then international bonds, and credit rating, and all these kind of things we're going to talk about this chapter. All right. Now, let me see. The world's bond market is, from statistical point of view, the total market value of the world's bond market are about 50% larger than the world's equity market. Actually, right, the bond market, fixed income, we say it, fixed income market is a lot bigger than the equity market, even though the textbook or in your investment as an individual investor, stock market is much more exciting, but predominantly, okay, the most important part of the investment is about fixed income, okay? And then the Rothschild, right, 200 years ago, they had this motto, right? If you want to do a business of banking, do it with the safest guy and the most powerful guy, which is the government, right? Or the monarchs, right? The most powerful and then the risk-free entity. You want to do business with them, okay? So, bond market is the most typical instrument for this kind of government entities, right? And then the US dollar, the euro, the pound sterling, and the yen are the four currencies in which the majority of the domestic and international bonds are denominated. Now, the proportionately more domestic bonds than international bonds are denominated in the United States dollar, right, and the yen, while more international bonds than domestic bonds are denominated in euro. Okay, and the pound sterling, right? So that's that. The amount of domestic and international bonds outstanding, you see this table over here from 2014 to 2018. US currency, the currency-wise, US dollar, euro, pound sterling. Predominantly it's US dollars, but euro is also big, and pound sterling has been there, and then Japanese yen has been there, Australian dollars, bonds has been there, and Swiss franc has been there, but it's rather shrinking, and the others, right? You see that bond market size has been steady, but yet a little bit growing until 2008. Then the classification of bonds, right? There are a lot of different ways of classifying bonds, and you may think like bond versus stock. Aren't they, the stock is frequently traded in exchanges, right? Like Samsung Electronics or Tesla Motors, they are traded every millisecond, right? Changing hands at every millisecond. Why? Because it is very simple and standardized, right? Very standardized. One share, and then all you get is a dividend in the future, equal amount per share, right? And quite standardized. But bond is not that much standardized actually, okay, compared to stocks. So bond is not that much frequently traded, okay, not millisecond. Before you buy or sell any bond, you have to make sure about the covenants and then the detailed legal restrictions or legal contract written in that fine print. So it takes time for the investors to understand the detail of the bond, right? So that's why it's less frequently traded. ExxonMobil, the biggest corporation in manufacturing, right, in America, they have a bond, right? Their corporate bonds are traded, they say, once per, like a week or something, right? Once per week or day maybe, but less frequent. Obviously, their shares are traded every millisecond, but bonds a lot less frequent. And then the classification of bonds accordingly, like those features and then the fine prints, right? You can classify these bonds into different ways. Bearer bonds versus registered bonds, national security registrations, and then withholding taxes. Depending on these features, you can classify into different categories. And recent regulatory changes are involved, and global bonds versus not is also another way of classifying the bonds. Now, let's go one by one. Here, right? Foreign bonds versus Euro bond is also one category that you can classify. Euro bond, okay? Eurobond is a bond issued outside the home country of the issuer through an international syndicate and sold to investors residing in various countries. Eurobonds are usually denominated in a currency other than that of the currency of placement. Okay. Foreign bonds, in contrast, are issued by foreign issuers in a foreign national market and are denominated in the currency of that market. So foreign bond issuance is regulated by the rules of the host national market. Okay, this may be confusing, right? Eurobond versus foreign bond. Now, foreign bonds versus Euro bonds, I give you examples over here, right? If you come to Korea, right? Korea, these Arirang bond is one kind, and then Kimchi bond is another kind from the perspective of the foreign investors, right? The Arirang bond is a bond issued in terms of Korean won. This is Korea, but the issuer or the borrower is not a Korean company, but non-Korean or foreign companies, right? They're issuing bond in Korean won. Maybe Coca-Cola may be issuing a foreign bond in Korea and in the unit of Korean won. Okay, that's going to be Arirang bond. Kimchi bond, right? I should not sound like American here. Kimchi bond, right? Is a bond issued by the foreigners in U.S. currency or other currencies than Korean won, right? If Coca-Cola issues a bond in U.S. dollar terms or Japanese yen, but issued inside Korea, inviting Korean investors, that's going to be kimchi bond, all right? If you go to Japan, they have samurai bond versus shogun bond, right? Samurai bond, what is that? Well, foreigners issuing bond in Japanese yen in Japan, right? They're inviting Japanese investors, right, in their home currency. Shogun bond is the one that foreign companies issue in Japan in non-Japanese yen currency. Okay, so if Samsung goes there and then issue US dollar bond in Tokyo, that's going to be a Shogun bond, right? Still confusing? Yeah. Panda bond versus dim sum bond. This is China. Okay, so any foreign company goes to Beijing, Shenzhen, Shanghai, and then issue Chinese yuan denominated bond, right? Inviting Chinese local investors in their own currency. That's panda bond. But if the same foreign national companies issue bond in the same Shanghai or Beijing, but in different currencies than Chinese yuan, like issuing in Korean won or British pound sterling, then that is dim sum bond, all right? And then you may be familiar with the names such as Yankee Bond, Bulldog Bond, and Rembrandt Bond, Kangaroo Bond. These are foreign bonds in respective countries. Like Yankee Bond is like America. And Bulldog Bond, that's for Britain. Rembrandt Bond, that is Netherlands. Kangaroo Bond, of course, that's Australian one. Okay. I don't know. How about New Zealand? Kiwi? I don't know. So international bonds amount outstanding classified by major instrument are shown over here in US dollar terms from 2011 to 2015. And then instruments are like a straight fixed rate bond is there. That is just a straight fixed rate bond is coupon rate is fixed, okay, throughout the life of the bond. If it is 30 years bond, the coupon payment is fixed at the beginning, right? Straight fixed rate. Okay, that's that. And then floating rate bond is the coupon rate is not fixed. It's going to be benchmarked at LIBOR, right? LIBOR plus somehow. Floating rate notes take up significant part of it. And then convertible bonds are also there. And then bond with warrants is also there for you. Okay. And then bonds classification could be bearer bonds versus registered bonds. Bearer bonds are bonds with no registered owner. As such, they offer an anonymity, but they also offer the same risk of loss as currency. Okay, whoever bears this bond will receive that principal amount and coupon amount in the future. That's bearer's bond. Registered bonds are the bonds where the owner's name is registered with the issuer. Okay, so the bond issuer, the borrower, specifically keeps the name of the lender or the bond holder, okay, at the time of the bond issuance, right? So only those registered guys can get the money at the end of maturity. U.S. security law requires Yankee bonds sold to U.S. citizens to be registered, and then that's one regulation. And then Yankee Bonds, national security registrations. Yankee Bonds must meet the requirements of the SEC, Security Exchange Commission, just like the US domestic bonds. Many borrowers, remember Yankee Bond is a bond issued by foreign companies from the US perspective, issued in US dollars. The purpose is to invite US investors, right, in US dollars. Now, many borrowers find this level of regulation burdensome and prefer to raise US dollars in the Eurobond market. Eurobonds sold in the primary market in the United States may not be sold to US citizens. Of course, a US citizen could buy a Eurobond on the secondary market. Primary bond versus secondary market primary market versus secondary market. What is that about? Well, primary market is the issuance market. When you initially issue bond, right? That's a primary market of the bond, right? Equivalent thing in stock market is doing IPO, initial public offering for a stock, right? These days, a lot of stocks or companies are doing IPOs because it's a bubble time or boom time for the stock market, right? That's IPO is a primary market in the stock investment. Secondary market is whatever happens after IPO or whatever happens after the initial issuance of this bond, right? Buying and selling, those trading among other third-party investors, right? That's secondary market. Anyway, and then withholding taxes, right? 원천징수세, right? In Korean terminology. Now, prior to 1984, the United States required a 30% withholding tax on interest paid to non-residents who held the U.S. government or U.S. corporate bonds. The repeal of this tax led to a substantial shift in the relative yields on U.S. government and euro-dollar bonds. This lends credence to the notion that market participants react to tax code changes. Of course, investors are very sensitive to the movement of the tax rate or tax regulation, by the way. Next video, we are going to talk about the rest of these slides, like security regulations that ease bond issuance and things like that. So thanks for watching until now. Right, see you later.